Iron Condor is a defined risk play. Hey guys, today I'm going to show you how to place an Iron Condor. So a quick summary of what an Iron Condor actually is. We'll take a look at this graph. Iron Condor is when we sell a call here out of the money and sell a put here out of the money. And we make profit as long as the price of the underlying stock stays in between these two strike prices. Now, had we only placed this call and this put, the stock falls lower than this put, our losses would be infinite. The stock falls higher because we sold a call here, our losses would also be infinite. So what an Iron Condor does is we buy a put here to cap our losses, and we buy a call here to cap our losses. Iron Condor is a defined risk play. Without these two buys, this would be undefined risk. The risk would be limitless. This is why options trading is so powerful and why Iron Condors are so cool. Is the stock doesn't even have to be going up or down. This is a neutral strategy. If you think the stock is just going to roughly hover between the two price points, then Iron Condors are a great way to take advantage of that. Now, I've looked at a couple of stocks and I think Facebook would be a good one. Now, the reason I'm choosing Facebook for this Iron Condor is because number one, its implied volatility is high. The implied volatility is more than 40-50%. When implied volatility is high, our premiums are higher. And when our premiums are higher, we can increase the width of our strike prices. And with the larger width, we have better win rates. The other reason I'm considering Facebook is just looking at its trend. There doesn't seem to be any sharp movements in the most recent couple of days. There's a tiny reversal, but it seems fairly flat. And if we place the Condor with expiry on Friday, hopefully it shouldn't move that much. Now, how do we decide which prices to place our positions? Let's look at where we want to sell the call. I don't think it's going to go higher than 280, 285 in the next couple of days. So if we go to sell call, yeah, it shouldn't go higher than this, but actually I want to be safe and choose about a 20 delta or 1 standard deviation. I think this is pretty safe. Let's do a sell call here. And then I'm just going to buy a call right above it. So that's what caps our losses. And our max losses will be the difference between these two strike prices. So $2.5 times 100, $250 would be our max loss. And you see, we're getting the full premium of this strike price, but then we are also paying insurance with this call, and that cuts into our profit. And then let's go back and look at our resistance, 270, 271. Now we go sell a put here. So I don't think it'll go above 270, but this is too risky. This is too close to the current share price. I like to do at least 1 standard deviation away. So let's do this again, about 18 delta at 84%. That's about right. So we're selling a put here and buying a put here. And as we can see, our total credit, same thing as what happened to the call. We got $1.19 for the premium, but we're buying insurance, so that cuts into the premium, and we add all the premiums together, which would be 70 cents. This stock is definitely going to move, but it doesn't matter if it goes up or down, as long as it stays in between our 285 sell and our 265 sell. All of these will expire out of the money, and we will get to keep the premium. When the options are in the money, that means we would get assigned. We want these all to expire out of the money, and as long as they expire out of the money, we get to keep the premium because we are the option seller. As the option buyer or holder, generally you would want to have your options in the money, but as a seller, we want them out of the money. So continue. 1.8 review order. So ideally, we want our minimum credit to be at least 1/3 of the collateral. So right now it's hovering about that. This is not the perfect trade because we're risking $2 to make $1, but it's not bad. And I just want to show you guys what it's like. And also for me, I haven't done that many Iron Condors, so I think it's good to play one for practice. And I think we're okay. I'm looking at this stock and it doesn't seem like it should go too crazy. Hopefully we're in a period like this where we're just gonna go up and down, up and down. Let's do it. This is the price of education. If it works, I make money. If it doesn't work, I learn an expensive lesson. And there we go. So because I put an estimated credit of $80, It's very possible this won't get filled, to be honest. These spreads are a lot harder to fill than individual calls or puts, or even debit spreads or credit spreads, because there's just so many legs going. I actually placed another Iron Condor earlier today and it still hasn't filled. But yeah, that's it. Hopefully that gives you some clarity on how it works and how you can do it yourself. This is definitely one of the safer plays because, again, you have defined risk. Your losses are capped, and before you do any undefined risk plays, you should try these out first. Please like and subscribe if that was helpful. I'm also starting an intro to options series that starts from the very beginning, from what an option is, with lessons all the way up to more advanced option trading techniques. This is the best channel where newbie squires become professional knights. Watch my whole journey live as I'm learning, as I'm making mistakes. Thank you so much for watching and stay tuned.